The media is a machine designed to make you anxious. It preys on your most primal instincts, fear and greed. Turn on any financial news channel, and you are bombarded with a non-stop torrent of breaking news, hot stock tips, and dire warnings. The ticker at the bottom of the screen flashes red and green, a frantic heartbeat measuring the market's every spasm. Experts with confident voices tell you what to buy now, what to sell immediately, and which revolutionary technology is about to change the world. They create a narrative of constant urgent action. They make you feel that if you're not trading, if you're not participating in the story of the day, you are being left behind. They are selling you a ticket to a game where the odds are overwhelmingly stacked against you. And this is the great, tragic irony. The very act of paying attention to this daily circus is precisely what is keeping you from building real, lasting wealth. The media isn't just reporting on the market, it is actively making you a worse investor. It is making you poor. Warren Buffett, a man who has compounded wealth on a scale that beggars belief, understands this on a cellular level. His entire philosophy is built on a foundation of rejecting the noise, of turning off the television, of recognizing that by the time a company is a media darling, the opportunity for life-changing returns has already evaporated. The real money, the generational wealth, isn't made in the glaring spotlight of public opinion. It's made in the quiet, dusty, forgotten corners of the market, in businesses so boring they would never warrant a breathless segment between commercials. Buffett's ultimate secret isn't a complex formula or a proprietary algorithm. It's a profound and deceptively simple principle. A business that is constantly in the headlines is often a poor investment, because all the good news, all the hype, and all the optimistic projections are already baked into the price. The costly mistake this prevents is the single greatest trap for the retail investor: buying popular, well-loved, can't-miss stocks at exorbitant valuations, which leads to decades of stagnant returns, even if the underlying business continues to perform admirably. By mastering this single idea, you will undergo a financial transformation. You will stop being a consumer of market narratives and become a hunter of true, underlying value. You will learn to find opportunities in the silence, to buy excellent businesses before they become popular, before their prices are bid up to the stratosphere by the very same crowd that is currently ignoring them. This is the final promise of a rational approach to investing. It is the path to freeing yourself from the herd and achieving a level of portfolio growth you previously thought was reserved for the financial elite. Let's begin by dismantling the very stage upon which this financial drama is performed. We will explore the 5 pillars that support this contrarian strategy. The first is understanding the fundamental curse of the spotlight, why media attention is a poison pill for future returns. Second, we will uncover the powerful economics of obscurity, learning why boring is beautiful and profitable. Third, we will dissect the mind of the contrarian, the psychological fortitude required to stand apart from the crowd and act rationally when everyone else is losing their minds. Fourth, we will assemble the hunter's toolkit, a practical, step-by-step guide to actually finding these hidden gems in a sea of market noise. And finally, we will embrace the ultimate superpower in a world obsessed with speed, patience, the engine that turns good investments into dynastic fortunes. By the end of our journey, the flashing ticker and the shouting experts on television will no longer trigger anxiety or greed. They will become nothing more than a signal, a beacon telling you exactly where not to look, freeing you to begin your hunt in the quiet, profitable shadows. The first pillar of this entire philosophy is built on a simple but profound observation. The spotlight is not a sign of opportunity, it is a tombstone for future returns. When a company becomes the talk of the town, when its CEO is on the cover of magazines and its story is breathlessly repeated on every financial news network, it has undergone a fundamental transformation. It ceases to be just a business and becomes a narrative, a story of success and inevitable triumph. Investors are no longer buying a share of future earnings. They are buying a piece of that popular story. The price detaches from the underlying reality of the balance sheet and floats into the ether of pure sentiment. This is the curse of the spotlight, and falling for its allure is the fastest way to underperform the market for decades. To truly understand this, we must travel back in time, to an era of immense social upheaval and market turmoil, and witness a young Warren Buffett making a move that seemed, to the outside world, like sheer madness. The year is 1973. The American psyche is being battered by the Watergate scandal. The economy is groaning under the weight of an oil crisis and stagflation. The stock market is in the midst of a brutal bear market that will ultimately cut it in half. It is a time of deep pessimism and fear. In this environment, the prevailing investment wisdom was concentrated in a group of stocks known as the Nifty 50. These were the darlings of the era, companies like Coca-Cola, IBM, Polaroid, Disney, and Xerox. They were seen as one-decision stocks. The theory was that these companies were so dominant, so certain to grow forever, that you could buy them at any price, lock them away, and your financial freedom was guaranteed. They were the stars of the show, constantly in the headlines for their incredible growth and unassailable market positions. Wall Street analysts adored them, and institutional wealth management firms poured billions into them, pushing their valuations to dizzying, unprecedented heights. It was not uncommon for a Nifty 50 stock to trade at 50, 60, or even 80 times its annual earnings. The price, it was argued, was irrelevant. But Warren Buffett wasn't looking at the Nifty 50, he was looking at something else entirely. He was looking at a business that was, ironically, at the very center of the nation's biggest headline, but as an investment it was treated like a pariah. He was looking at the Washington Post company. On the surface, it was a terrible time to invest in the newspaper. The Post, led by Katharine Graham, was engaged in a high-stakes existential battle with the Nixon administration over its reporting on the Watergate scandal. The political pressure was immense. Simultaneously, the company was facing debilitating union strikes that were disrupting its operations. The stock market, as we've noted, was collapsing, and investors wanted nothing to do with cyclical businesses like newspapers, let alone one that seemed to be in the crosshairs of the most powerful man in the world. The company's stock had fallen by nearly half. While the Nifty 50 were hailed as the safe, smart money, the Washington Post was seen as a toxic asset, fraught with political and operational risk. This is where Buffett's contrarian genius shone through. He ignored the deafening noise of the headlines and did what he always does. He analyzed the business. He looked past the temporary political storm and the cyclical market downturn and saw a media titan with an unshakable economic fortress. The Washington Post was the dominant newspaper in a powerful and affluent city. It had a virtual monopoly on the attention of the nation's political class. This gave it immense pricing power with its advertisers. He also saw a collection of other valuable assets, including Newsweek magazine and several television stations, that were being completely overlooked by the market in its panic. He calculated the intrinsic value of the company, piece by piece, and arrived at a figure somewhere between $400 million and $500 million. And what was the stock market and its infinite wisdom valuing the entire company at? A mere $80 million. The market was so fixated on the terrifying front-page narrative of Watergate and strikes that it was willing to sell a dollar bill for 20 cents. Between 1973 and 1974, Buffett, through his partnership, methodically and quietly invested $10.6 million to acquire a substantial stake in the company. He wasn't buying a popular story, he was buying a phenomenal business at a price that was ludicrously cheap, precisely because the story surrounding it was so negative. The outcome of this investment is the stuff of legend. The Washington Post not only survived the turmoil but thrived. As the years went by, the market's fear subsided, and it began to recognize the incredible economic engine that Buffett had identified. That $10.6 million investment would, over the next 3 decades, grow to be worth over $1.5 billion. It became one of the cornerstones of Berkshire Hathaway's burgeoning empire, a testament to the power of buying when the headlines are screaming sell. The story of the Washington Post and the Nifty 50 is a perfect illustration of the psychological principles that drive this market madness. The primary culprit is a cognitive bias known as the availability heuristic. Our brains are wired to make judgments based on information that is easily recalled. We mistake ease of recall for importance and probability. When a stock like Polaroid or Xerox is constantly in the news, featured in magazines, and discussed by our peers, its name becomes readily available in our minds. We see its stock price going up month after month. This constant exposure creates a mental shortcut. We subconsciously conclude that because it's so visible and so praised, it must be a safe and intelligent investment. The risk seems low because the story is so familiar and positive. Conversely, a business mired in negative headlines like the Washington Post in 1973 triggers an opposite availability heuristic. The easily recalled information is all negative. Political pressure, strikes, a bear market. Our brain screams danger, even if a rational analysis of the underlying assets would reveal a massive opportunity. This is amplified by a second, even more powerful bias: herd behavior or social proof. As social creatures, we are deeply programmed to find safety in numbers. For millennia, straying from the tribe meant death. This instinct is alive and well in financial markets. When everyone we know and respect is buying the Nifty 50, it feels psychologically dangerous to do the opposite. To stand alone and buy the hated, feared stock is an act of profound social defiance. It creates a feeling of isolation and doubt. Could all these smart people be wrong, we ask ourselves. What do they know that I don't? This pressure to conform leads to massive informational cascades. The rising price of a popular stock attracts more buyers, which creates more positive media coverage, which in turn attracts even more buyers. The price becomes a signal in and of itself, divorced from any fundamental reality. People aren't buying the business, they are buying the fact that other people are buying. This is the very definition of a bubble, and it is fueled by our deepest, most ancient psychological wiring. Buffett's genius is not just his analytical ability, it's his emotional and psychological ability to override these powerful instincts, to ignore the siren song of the herd, and to trust his own independent analysis, even when it means standing completely alone. So how can you, the individual investor, build a system to counteract these powerful biases and apply this pillar to your own wealth management? You need a practical mental model, a blueprint for action. I call this the headline inversion model. It is a systematic process for using the media's spotlight as a contrary indicator. Step 1 is to actively create a too much hype list. Spend a week consciously monitoring the financial media. Don't consume it for ideas. Consume it as an anthropologist studying a strange tribe. What are the 5 or 10 stocks that are mentioned constantly? Which CEOs are being lauded as visionaries? Which companies are on the covers of Forbes or Fortune? Write these names down. This is not your buy list, this is your avoid for now list. Step 2. For every company on your hype list, pull up a 10-year chart of its stock price and, more importantly, its price-to-earnings PE ratio or price-to-sales PS ratio. You will almost invariably see a strong correlation. As the media attention intensified, the valuation multiple expanded. The company became more and more expensive relative to its actual business performance. This visual evidence will train your brain to associate media hype with financial risk, not opportunity. Step 3 is to make a hard and fast rule for yourself. A commitment. For example, I will not buy a stock that has been featured on the cover of a major business magazine in the past 12 months. This simple rule acts as a circuit breaker, preventing you from getting caught up in the final, most dangerous stage of a hype cycle. Finally, step 4 is to do the inverse. Create a too much fear list. What industries are being savaged in the headlines? Are there fears about new regulations hitting the banking sector? Is everyone predicting the death of retail stores? Is there a temporary supply chain issue plaguing manufacturers? These sectors, the ones everyone else is fleeing, become your initial hunting ground. This model doesn't tell you what to buy, it tells you where to look. It forces you to systematically invert the message of the media, pointing you towards the neglected corners where real value might be hiding. It is the first crucial step in your journey to becoming a contrarian investor. To fully appreciate the wisdom of this approach, we must spend some time examining the alternative, the path that 99% of investors instinctively follow. This is the path of chasing the narrative, and its destination is almost always financial disappointment. The ultimate cautionary tale, as we've mentioned, is the fate of the Nifty 50. In the early 1970s, buying these stocks was considered the epitome of prudent, long-term investing. You were buying American greatness. You were buying the future. Take a company like Polaroid. It was the Apple of its day, a technological marvel with a beloved product and seemingly endless growth ahead. In 1972, it traded at a staggering 91 times its earnings. Investors, swept up in the narrative of innovation, happily paid that price. Then came the 1973-74 crash. The market's sentiment shattered, and the high-flying Nifty 50 were brought crashing down to earth. Polaroid's stock collapsed by over 90%. An investor who bought at the peak in 1972 would have had to wait over a decade just to get back to even, and that's before accounting for inflation. Even a titan like Coca-Cola, a truly wonderful business, was a terrible investment for a time. Bought at its peak valuation in 1972, its stock went essentially nowhere for the next 10 years. The business itself grew, but all that growth went to justifying the absurdly high price the initial investor had paid. The air was simply coming out of the valuation bubble. This is a critical lesson. A great company can be a terrible investment if you pay too much for it. The 99% focus on the quality of the company, which is easy to see and widely discussed. The successful contrarian focuses on the price of the company relative to its value, which requires independent thought and a willingness to ignore the popular narrative. The portfolios of those who chased the Nifty 50 in the early 70s were decimated, not because they bought bad companies, but because they bought good companies at prices that had been inflated by the very spotlight they were drawn to. Let's connect this directly to the numbers, to the cold, hard reality of your financial statements and portfolio growth. The impact of paying a popularity premium is not theoretical. It is a mathematical certainty that acts as a lead weight on your capital gains. Imagine two scenarios. In scenario A, you buy hype stock, a media darling that everyone loves. It's a fantastic business, projected to grow its earnings by a healthy 15% per year. But because of its popularity, it trades at a PE ratio of 60. In scenario B, you buy boring stock, a company in a neglected industry. It's a good, solid business, but it only grows its earnings by 10% per year because no one is talking about it. It trades at a deeply unfashionable PE ratio of 8. Now, let's fast forward 10 years. Let's assume both businesses perform exactly as expected. Hype stock's earnings have more than quadrupled. But over that decade, the market sentiment has cooled. It's no longer the hot new thing. People now value it at a more reasonable PE of 20. The business is 4 times larger, but the valuation multiple has been cut by 2/3. The result? The stock price has barely budged. Your return over a decade is close to zero. You were right about the business, but you were so wrong about the starting price that all of that wonderful business growth simply went to correcting your initial mistake. Now look at boring stock. Its earnings have grown by 10% a year, more than doubling over the decade. But something else has happened. The market has started to notice its steady, reliable performance. A few analysts have started covering it. It's no longer a complete pariah. Its PE ratio has expanded from a cheap 8 to a more average 15. So what is your return? Your earnings have more than doubled, and the multiple the market is willing to pay for those earnings has nearly doubled as well. Your stock is up over 4-fold. You've achieved a spectacular market-beating return from a boring business, while the investor in the exciting business has gone nowhere. This is the direct financial connection. The price you pay determines your rate of return. The curse of the spotlight seduces you into paying a high price, all but guaranteeing you a low return. By inverting the headlines and seeking out the forgotten, you give yourself the twin engines of portfolio growth, earnings growth, and time multiple expansion. That is how real wealth is built. Having established that the media spotlight is a danger zone for investors, we must now venture into the shadows to explore our second pillar, the powerful and often misunderstood economics of obscurity. If hype is expensive, then neglect must be cheap. But it's more than just about finding a bargain. Obscure, boring, and overlooked businesses often possess unique economic characteristics that make them exceptionally resilient and profitable. Wall Street's relentless focus on quarterly growth and exciting narratives creates massive blind spots. In these blind spots, entire ecosystems of wonderful businesses thrive, unnoticed by the large funds and the chattering classes of financial television. Understanding why these businesses are so attractive is the key to turning the market's neglect from a perceived risk into your single greatest asset. To see this principle in action, we need to look at one of Buffett's most formative and revealing investments, a deal that taught him more about business economics than almost any other: the acquisition of a simple candy company. The year was 1972, and Buffett and his partner Charlie Munger were running Berkshire Hathaway, then a struggling textile manufacturer they were slowly transforming into an investment vehicle. Munger brought a company to Buffett's attention: See's Candies. On the surface, it was the antithesis of the kind of exciting, world-changing companies that captivated Wall Street. See's was a family-owned box candy company based primarily in California. It was founded in 1921 and had built a loyal following through its old-fashioned, high-quality chocolates and its black-and-white stores. It wasn't a technology company, it wasn't expanding rapidly across the country, it was, in a word, boring. It was so obscure that it barely registered as a blip on the national investment radar. There were no sell-side analysts issuing quarterly reports on the box chocolate market. There were no breathless headlines about its latest product launch. It existed in a quiet world of its own. Buffett and Munger, however, saw something that the rest of the market completely missed. They didn't see a boring candy company. They saw a business with extraordinary economics, a financial fortress disguised as a chocolate shop. First, they saw a powerful, albeit regional, brand. Customers had an intense emotional connection to See's Candies. They bought it for holidays, birthdays, and special occasions. The brand was associated with nostalgia, quality, and happiness. This powerful brand loyalty gave the company something truly magical: pricing power. Each year, See's could raise its prices by a small amount to cover inflation and then some, and the customers wouldn't flinch. They weren't just buying chocolate, they were buying a tradition, and they were willing to pay for it. Second, they saw a business that required very little capital to grow. The profits the company generated didn't need to be constantly plowed back into expensive new factories or massive research and development projects. The business was a cash machine, gushing out profits year after year that could be taken out and used for other purposes. Blue Chip Stamps, a company controlled by Buffett and Munger, ended up purchasing See's for $25 million. This price was about 3 times what the See family had initially thought the company was worth. But Buffett knew he was getting a bargain. He wasn't buying tangible assets like factories and inventory. He was buying an intangible asset, the brand and its associated pricing power, that existed in the minds of its customers and was completely invisible on the balance sheet. Over the years, See's Candies has generated over $2 billion in pre-tax earnings for Berkshire Hathaway, all of which has been deployed to buy other wonderful businesses. It became Buffett's prototype for the ideal business, one that is overlooked, has a durable competitive advantage, and produces far more cash than it consumes. It was a masterclass in the economics of obscurity. The reason the wider market overlooks gems like See's Candies lies in a pair of deeply ingrained psychological biases. The first is the ambiguity effect. Humans have a natural aversion to the unknown. We prefer to take a risk in a situation where the probabilities are known, a known risk, over a situation where the probabilities are unknown, an unknown risk or ambiguity. A massive, heavily followed company like General Electric has thousands of pages of analyst reports written about it every month. Its every move is scrutinized. While its stock price may be high, the business itself feels like a known quantity. The risks, investors believe, are well understood. An obscure company like See's in 1972 had virtually no public analysis. To an outsider, it was a black box. What were the trends in the California candy market? Who were its competitors? What were its profit margins? The lack of readily available information creates a sense of ambiguity, which the human brain interprets as risk. Most investors will simply avoid it and stick to the familiar, well-lit areas of the market. This is where a contrarian gains their edge. By being willing to do the hard, independent work of reading the annual reports and studying the business, you can resolve the ambiguity for yourself. You can turn the unknown into the known, transforming the market's aversion to ambiguity into a massive source of opportunity. The second bias at play is scope neglect. This is our tendency to be insensitive to the magnitude of a problem or opportunity. Wall Street is obsessed with scale. Investment banks and large mutual funds need to deploy billions of dollars of capital. A small $25 million acquisition like See's Candies is simply too small to matter to them. It wouldn't move the needle on their multi-billion-dollar portfolios. Because of this, they neglect the entire universe of small and mid-sized companies, regardless of their quality. They are hunting for elephants, so they walk right past the fields full of diamonds. This scope neglect from the big players creates a wonderfully inefficient market for the individual retail investor or entrepreneur. You are not constrained by size. You can find an incredible, undervalued business with a market capitalization of $500 million, and it can have a meaningful impact on your portfolio. Buffett, even in 1972, was practicing this. He was willing to look at deals of all sizes, understanding that a wonderful business is a wonderful business, regardless of its scale. He was exploiting the scope neglect of the larger financial institutions. To operationalize this search for the profitable and obscure, you can employ a mental model I call the boring business screen. This is a systematic method for using stock screening tools to generate a list of potential investment ideas that the market is likely ignoring. Step 1 is to explicitly define what boring means in an industrial context. Sit down and brainstorm a list of industries that rarely, if ever, make the front page of the Wall Street Journal. Think about things like industrial fasteners and adhesives, waste management services, commercial uniform rentals, manufacturers of specialized pumps or valves, regional banks, and property and casualty insurance companies. The less glamorous, the better. Step 2 is to go to a financial data website with a robust stock screener. You will now input a set of specific criteria designed to filter for obscurity and quality. For market capitalization, set a range between, say, $300 million and $4 billion. This is a sweet spot, large enough for the business to be stable and established, but too small to attract the attention of the giant institutional funds. For profitability, screen for companies that have been profitable, had positive earnings per share, in at least 8 of the last 10 years. This filters out speculative ventures and focuses on businesses with a history of resilience. For analyst coverage, this is key. Set the filter to fewer than 5 analysts. This is a direct measure of obscurity. If Wall Street isn't paying attention, you have a better chance of finding an undiscovered gem. Finally, for valuation, add some basic criteria like a P/E ratio below 15 and a price-to-book ratio below 2. Step 3. Run the screen. The list of companies that it generates will be your initial hunting ground. You will likely have never heard of most of them. This is a good sign. Step 4 is where the real work begins. For each company on the list, you must begin the process of reading their annual reports and trying to answer a single critical question. Why is this business boring, and is the source of its boringness also the source of a durable competitive advantage? For example, a company that makes a highly specific, critical component for medical devices might be boring, but it might have a deep moat due to high switching costs and regulatory hurdles for its customers. The boring business screen is your tool for turning the market's collective yawn into a curated list of potentially explosive investment opportunities. The path of the 99% is the polar opposite of this approach. It is the path of chasing excitement, narrative, and revolutionary stories. There is no more stark example of this than the dot-com bubble of the late 1990s. The principles of value investing in boring businesses were declared dead. A new economy had arrived, and the old rules no longer applied. Investors, both professional and retail, abandoned any pretense of fundamental analysis. They poured capital into companies with no revenues, no profits, and often no coherent business plan. The only thing that mattered was the story. Was the company involved in the internet? Did its name end in .com? If so, its stock was destined for the moon. Companies like Pets.com, which was losing money on every bag of dog food it sold, or Webvan, an online grocery delivery service that built out an impossibly expensive infrastructure, achieved multi-billion-dollar valuations overnight. The media fanned the flames, celebrating teenage tech founders as financial geniuses. The social proof was overwhelming. Your neighbor, your dentist, your taxi driver were all getting rich trading .com stocks. To sit on the sidelines, to hold shares in a boring old economy business, felt like an act of financial suicide. You were a dinosaur, a relic of a bygone era. Meanwhile, profitable, established businesses in boring industries were treated with contempt, their stocks languishing at single-digit PE ratios. Then, in March of 2000, the bubble burst. The narrative collapsed. The paper fortunes evaporated. Companies that were once worth billions went bankrupt in a matter of months. Trillions of dollars of investor wealth were wiped out. It was a brutal, catastrophic lesson in the dangers of choosing an exciting story over boring economics. The 99% who chased the hype were financially ruined, while the patient contrarians who had been quietly accumulating shares in undervalued, profitable businesses were presented with the buying opportunity of a lifetime. The financial connection between obscurity and superior returns is rooted in one of the most important concepts in all of investing, Benjamin Graham's margin of safety. When you buy a popular, hyped-up stock, you are likely paying a price that is at or above its true intrinsic value. You have no margin of safety. If the company stumbles, if its growth slows even slightly, or if market sentiment simply changes, your investment is vulnerable to a steep decline. There is no cushion to protect you. When you buy an obscure, neglected, boring business at a PE of 8, you are doing the opposite. You are deliberately buying assets for far less than they are worth. Let's say you do a thorough analysis of a boring manufacturing company and calculate its intrinsic value to be $100 per share. Thanks to the market's neglect, its stock is currently trading at $50 per share. That $50 gap between the value and the price is your margin of safety. This margin of safety provides two crucial benefits that directly enhance your wealth management and portfolio growth. First, it provides powerful downside protection. If you made a mistake in your analysis and the company is only worth $70 per share, you still stand to make a profit. If the company hits a rough patch and its value temporarily drops to $60, your investment is still secure. The initial discount acts as a massive financial shock absorber. Second, it provides a powerful source of upside. Your potential return doesn't just come from the future growth of the business's earnings. It also comes from the market eventually closing that valuation gap. When other investors finally recognize the company's true worth and bid the price up from $50 to its intrinsic value of $100, you get a 100% return before any business growth even occurs. This re-rating of the stock's multiple is a source of capital gains that is completely unavailable to the investor who buys stocks that are already popular and fully priced. By hunting in the obscure corners of the market, you are systematically building a portfolio with lower risk and higher potential returns. You are tilting the odds of success dramatically in your favor. To successfully navigate these neglected corners of the market and stand firm against the howling gales of public opinion, you must cultivate a specific psychological disposition. This brings us to our third pillar, the mind of the contrarian. It's not enough to know that popular stocks are often overpriced and boring stocks are often cheap. You must possess the internal fortitude to act on that knowledge, especially when it feels most uncomfortable. Investing is not a game played on a spreadsheet. It's a game played in the theater of the human mind, a mind riddled with biases and emotional triggers that are hardwired for self-sabotage. A true contrarian isn't just someone who buys what others are selling. They are someone who has mastered their own emotional responses to fear and greed. This mastery is the rarest and most valuable skill in the entire financial world. For the quintessential story of contrarian conviction, we must go back to the early days of Buffett's career, to a scandal that rocked Wall Street and threatened to bring down one of America's most trusted financial institutions. The year was 1963. The company was American Express. At the time, American Express was known primarily for its traveler's checks and credit cards, but it also had a lesser-known but substantial business in field warehousing. Essentially, companies could secure loans by using their inventory as collateral, and American Express's warehousing subsidiary would certify the existence and value of that inventory. One of their biggest clients was the Allied Crude Vegetable Oil Refining Corporation, run by a charismatic fraudster named Tino DeAngelis. DeAngelis had managed to secure massive loans from dozens of banks, all collateralized by his supposed inventory of salad oil, which was stored in giant tanks in Bayonne, New Jersey, and certified by American Express. The problem was, most of the tanks were filled with seawater, with only a thin layer of salad oil floating on top. When the fraud was discovered, Allied Crude Vegetable Oil immediately went bankrupt, defaulting on an estimated $175 million in loans, a colossal sum at the time. The market was thrown into a state of absolute panic. Wall Street assumed that American Express, having certified the non-existent collateral, would be on the hook for the entire loss. This was a sum so large it would have bankrupted the company. The narrative was set. American Express was doomed. The headlines were apocalyptic. Investors, terrified, dumped the stock in a frenzy. The price was cut in half in a matter of weeks. The herd was stampeding for the exits. This was the moment that separated Warren Buffett from virtually every other money manager of his time. Instead of joining the panic, he saw a potential opportunity born from extreme fear. He asked a simple, rational question: is the market's fear justified? He didn't rely on the opinions of other analysts or the screaming headlines. He decided to do his own primary on-the-ground research, what he would later call scuttlebutt. He started visiting restaurants and talking to waiters. He went to banks and spoke with tellers. He had his associates do the same in other cities. He was looking for the answer to one question: was the salad oil scandal affecting the core business of American Express? He wanted to know if people were stopping their use of American Express credit cards and traveler's checks. The answer he got back was a resounding no. Customers and merchants didn't care about the warehousing division. They cared about the convenience and prestige of the card. The fundamental business, the real source of American Express's value, was completely unharmed by the scandal. He then dug into the company's legal and financial situation and concluded that while the losses would be painful, they were not going to be fatal. The market, in its panic, was throwing the baby out with the bathwater. It had conflated a problem in one small division with the entire enterprise. Convinced that the fear was wildly overblown, Buffett made one of the boldest bets of his career. He invested 40% of his entire partnership's capital into American Express stock. He was buying when the blood was in the streets. He was displaying the ultimate contrarian conviction. Over the next few years, as the company settled the legal claims for far less than feared, and the strength of its core business became undeniable, the stock price soared. Buffett's partnership made a fortune. This was a victory not just of analysis, but of temperament. It was a testament to a mind that could remain rational and independent while the rest of the world was consumed by panic. The psychological forces that Buffett had to overcome in the salad oil scandal are the same ones that lead the average investor to ruin. The most powerful of these is social proof, which we've touched on. When the stock of a company like American Express is plummeting and every expert on television is predicting its demise, Selling feels like the only rational choice. Every seller provides social proof to the next that selling is the right thing to do. To buy in that environment is to actively bet against the collective wisdom of the crowd. It requires an almost arrogant level of self-confidence in your own analysis. Our brains are not wired for this. We are wired to seek consensus. Fighting this urge is physically and mentally taxing. It is the core challenge of contrarian investing. The flip side of this is the fear of missing out, or FOMO. This is the herd instinct in a bull market. When a stock is soaring and our friends are bragging about their profits, a powerful anxiety builds within us. We feel like we are missing the party, that we are being left behind. This emotional pressure compels us to buy, often at the very peak of the market, just as the early, smart money is starting to sell. FOMO is the engine of bubbles. It causes investors to abandon their discipline and chase performance, buying high in the hopes of selling even higher. A true contrarian has developed the emotional calluses to withstand both the terror of being alone in a falling market and the siren song of missing out on a rising one. They understand that the moments of maximum fear are the moments of maximum opportunity, and the moments of maximum greed are the moments of maximum risk. To build this contrarian mindset, you need a tool that insulates your decision-making process from the emotional volatility of the market. This mental model is the investment journal and pre-mortem. It is a disciplined, written process that forces you to be rational before you put a single dollar at risk. Step 1 is to procure a physical journal, not a digital file. The physical act of writing slows down your thinking and deepens your commitment. Before you are allowed to buy any stock, you must open this journal and write out your complete investment thesis. This should be several pages long. Why are you buying this specific business? What is its competitive advantage? What are the key drivers of its future growth? Crucially, you must include your calculation of its intrinsic value, showing your work. What price would represent a significant margin of safety? What specific metrics or milestones will you be tracking to confirm that your thesis is playing out correctly? This document becomes your anchor of rationality. Step 2 is to immediately perform a pre-mortem. On the next page, you will write a detailed story from the perspective of 1 year in the future, where this investment has turned into a complete and utter disaster. Your goal is to imagine all the things that could have possibly gone wrong. Did a new competitor emerge with a better technology? Did the management team make a catastrophic capital allocation decision? Did a change in regulations destroy the industry's profitability? By forcing yourself to vividly imagine failure ahead of time, you confront the real risks of the investment head-on, counteracting the natural human tendency towards overconfidence and confirmation bias. Step 3 is the execution. Once you make an investment, your journal becomes your operating manual. When the market panics and your stock drops 30%, you are not allowed to sell. Your only permitted action is to take out your journal and reread your original thesis. Has anything happened in the real world to fundamentally invalidate what you wrote down in a moment of calm rationality? If the answer is no, then a lower price is not a reason to sell. It's a reason to buy more. This disciplined process creates a firewall between your rational, thinking brain and your emotional, panicking brain. It is the training ground for developing true executive decision-making and contrarian fortitude. The antithesis of this disciplined contrarian mindset was on full display for the entire world to see during the global financial crisis of 2008. As the subprime mortgage crisis metastasized and brought down giants like Lehman Brothers, a wave of fear unlike anything seen since the Great Depression swept across the globe. The headlines were not just negative, they were apocalyptic. The narrative was that the entire global financial system was on the verge of collapse. For the 99%, for the average retail investor, this was the ultimate test, and most failed spectacularly. Driven by overwhelming fear and the deafening social proof of a crashing market, they sold everything. They liquidated their 401ks and their brokerage accounts, often near the absolute bottom of the market in late 2008 and early 2009. They locked in devastating, life-altering losses. They capitulated at the precise moment of maximum pessimism. And what was Warren Buffett doing at this exact same time? He was writing an op-ed for the New York Times titled, "Buy American, I Am." He was publicly declaring his optimism, and, more importantly, he was acting on it. He was deploying billions of Berkshire Hathaway's dollars, investing in iconic American companies like Goldman Sachs and General Electric, not because he knew when the market would bottom, but because he knew that the prices on offer were ludicrously cheap relative to their long-term earning power. He was acting as a provider of liquidity and confidence to a market that had lost its mind. The retail investors who sold in a panic, who let their primal fear override any rational thought, cost themselves their chance at financial freedom. They missed out on the subsequent bull market, one of the longest and most powerful in history. They sold low out of fear and, more than likely, bought back in years later at much higher prices, driven by FOMO. This is the tragic, repeating cycle of the unprepared investor. The direct financial connection here is a concept that we can call volatility arbitrage. The 99% view stock market volatility as pure risk. When prices swing wildly, they feel a loss of control and a sense of danger. Their instinct is to run for safety, to convert their volatile stocks into stable cash. The contrarian investor, armed with a strong temperament and a solid analytical framework, sees volatility entirely differently. They see it as a source of opportunity. The emotional swings of the market, driven by fear and greed, regularly cause the quoted price of a business to become detached from its true underlying value. When a wave of panic selling drives the price of a wonderful company 30% or 40% below its intrinsic worth, the contrarian is able to step in and buy from the fearful seller. In essence, the fearful seller is paying the contrarian to take on the emotional distress that they themselves cannot bear. The payment comes in the form of a deeply discounted purchase price. This ability to profit from the emotional turmoil of others is a form of emotional alpha, a real and quantifiable source of excess returns that has nothing to do with complex algorithms or inside information. It is purely a return on your superior temperament. Over an investment lifetime, consistently being the calm buyer during panics and the skeptical seller during manias is a massive wealth multiplier. Your wealth management strategy becomes not just about picking good assets, but about arbitraging the very psychology of the market itself. This is the ultimate financial advantage that the mind of a contrarian provides. Now that we have fortified our minds and understand where to look, it is time to assemble our practical equipment. This brings us to our fourth pillar, the hunter's toolkit. A contrarian philosophy is useless without a rigorous, repeatable process for analyzing businesses and unearthing value. The 99% of investors operate with a toolkit that consists of little more than headlines, hot tips, and a cursory glance at a stock chart. The true hunter, by contrast, employs a disciplined methodology of deep research, specialization, and fundamental analysis. They are not looking for stories. They are looking for economic reality. They understand that a true informational edge doesn't come from illegal insider tips, but from the hard work of reading and thinking more deeply than anyone else about a business that the world has chosen to ignore. To see this toolkit in action, we must examine the very engine room of Berkshire Hathaway, the insurance business, and how Buffett's obsessive deep dive into this unglamorous industry laid the foundation for his entire fortune. In 1967, long before Berkshire Hathaway was a household name, Buffett made a relatively small but pivotal acquisition. He bought a small, Omaha-based insurance company called National Indemnity Company, along with its sister company, National Fire and Marine. To an outsider, this was a profoundly uninteresting business. They specialized in writing insurance for unconventional risks, things like insuring taxi fleets or commercial trucking operations, risks that many larger insurers wouldn't touch. Insurance is, to most people, a black box of mind-numbing complexity, filled with arcane terminology like, quote, combined ratios, reserves, and statutory accounting. Wall Street analysts, for the most part, treated it as a stodgy, low-growth industry. But Buffett didn't see a boring insurance company. He saw a financial rocket ship, if one understood its unique mechanics. He had spent years studying the insurance industry. He didn't just read the annual reports of the big, well-known insurers. He read the reports of dozens of small, obscure ones. He devoured industry trade publications like The National Underwriter. He learned the language and the math of insurance until he understood the business better than most industry CEOs. What he came to understand was the magical concept of float. Insurance companies collect premiums from their customers up front, but they only pay out claims later, sometimes many years later. This pool of money they hold in the interim, the premiums collected but not yet paid out, is the float. An insurance company gets to invest this float for its own benefit. If the company could simply break even on its actual insurance operations, meaning the premiums it collected were equal to the claims it eventually paid out and its operating expenses, it would still be able to make a profit from investing the float. And if the company had a disciplined underwriting culture and could consistently collect more in premiums than it paid out in claims and expenses, achieving what's called a combined ratio under 100, then it was being paid to hold and invest other people's money. This was, he realized, an even better business than banking, where you had to pay interest on your deposits. Buffett saw that National Indemnity, despite its small size, had a culture of disciplined underwriting. He wasn't just buying its current book of business, he was buying a machine that could generate an ever-increasing amount of investable float at a negative cost. The acquisition of National Indemnity and later Geico became the financial bedrock of Berkshire Hathaway. The float from the insurance operations provided the permanent, low-cost capital that Buffett used to buy See's Candies, The Washington Post, Coca-Cola, and all the other businesses that would turn Berkshire into a global behemoth. This triumph was not the result of a hot tip. It was the result of a decade of patient, obsessive study of an industry that most investors found too boring and too complicated to bother with. He built his own toolkit and became a specialist. The psychological reason that most investors fail to do this kind of deep work is captured perfectly by the Dunning-Kruger effect. This cognitive bias describes a situation where people with low ability at a task overestimate their own ability. In investing, a little bit of knowledge is a dangerous thing. The retail investor who reads a few news articles about a company and watches a segment on TV often feels a surge of confidence. They believe they have done their research. They are standing atop what psychologists call Mount Stupid on the Dunning-Kruger curve, blissfully unaware of the vast landscape of what they don't know. Once they form this initial positive impression, confirmation bias kicks in. They will subconsciously seek out information that confirms their belief and ignore information that contradicts it. They'll pay more attention to the bullish analyst report and dismiss the bearish one as the work of a short seller. This combination creates a dangerous feedback loop of overconfidence and shallow analysis. The hunter's toolkit is designed to be the antidote to this. The true contrarian starts from a position of profound humility. They assume they know nothing. Their goal is to move past Mount Stupid as quickly as possible and into the valley of despair, where they realize the true complexity of the business. Only by pushing through this valley with diligent work can they ascend to the slope of enlightenment and achieve true competence. This requires a conscious effort to seek out disconfirming evidence and to focus on a small, manageable area of study, what Buffett calls a circle of competence. So, what is the blueprint for building your own hunter's toolkit? It is a mental model called the Circle of Competence Audit and Deep Dive Protocol. It's a structured approach to becoming a specialist. Step 1 is the audit. You must honestly assess where your existing knowledge lies. Take out a piece of paper and create 3 columns: my profession, my serious hobbies, and industries I understand intuitively. If you've worked as a software engineer for 15 years, you have a massive, pre-built advantage in analyzing enterprise software companies. If you're a doctor, you can dissect the business models of medical device firms far better than a Wall Street generalist. If your hobby is restoring classic cars, you might have unique insights into the auto parts industry. This audit defines the initial boundaries of your circle of competence. Step 2 is to apply this filter to your screening. Take the boring business screen we developed earlier, but add one more crucial filter. Only show companies that operate within the industries you identified in your audit. This immediately focuses your attention on areas where you have an unfair advantage. Step 3 is the deep dive protocol. Once you've identified a promising company within your circle, you must commit to a rigorous research program. This is non-negotiable. You will download and read the last 5 years of the company's annual reports, the 10K filings, and the last 8 quarterly reports, the 10Q filings. These are dense, legalistic documents, but they contain the unvarnished truth about the business. You will then find and listen to the audio replays of the last 8 quarterly earnings conference calls to hear how management talks about the business and what questions analysts are asking. To understand the competitive landscape, you will then download the annual report of that company's closest competitor and read it. Finally, step 4 is what Buffett calls scuttlebutt. If possible, you must engage with the business in the real world. If it's a retail company, visit its stores. If it makes a product, buy it and try it. Read industry-specific trade journals, not just the mainstream financial press, to understand the nuances and trends that don't make the headlines. This intensive, multifaceted protocol is the work. It is how you build a true, defensible, informational edge and conduct a proper stock analysis. The path of the 99% is a tragic caricature of this process. The average retail investor's research often consists of a 5-minute burst of activity that provides only the illusion of diligence. They see a ticker symbol mentioned on a social media platform like Reddit or Twitter. They might then go to a portal like Yahoo Finance, where they'll look at the 1-year stock chart. If it's going up, that's a positive signal. They might glance at the summary statistics, the PE ratio, the market cap, without any real context for what those numbers mean for that specific industry. They might read the top 2 or 3 news headlines, which are often just summaries of recent price action. Based on this flimsy, superficial data, they make a decision to risk thousands of dollars of their hard-earned capital. They haven't read a single page of an annual report. They couldn't name the company's CEO or its top 3 competitors. They don't understand its balance sheet or its primary source of competitive advantage. They are not investing in a business they understand. They are placing a speculative bet on a ticker symbol they've heard about. This is not a strategy for long-term portfolio growth. It is a recipe for disaster. It ensures that you will buy things you don't understand, panic and sell them at the first sign of trouble, and ultimately transfer your wealth to the patient hunters who have done the real work. The direct financial connection of building and using this toolkit is the creation of a genuine information asymmetry. In today's world, there is a belief that because all public information is available on the internet, there is no informational edge left. This is a profound misunderstanding of how markets work. While the raw data in a 10K is available to everyone, the willpower to read it, the glow skill to interpret it, and the 10 patience to synthesize it are incredibly rare. By becoming a specialist in a small, neglected niche, by reading every filing and listening to every call, you create your own, perfectly legal, information asymmetry. You will simply understand the long-term economics and competitive position of that business better than 99% of the other market participants, including the professional Wall Street analysts, who are forced to cover dozens of companies across multiple industries and can't possibly go as deep as you can on one. This asymmetry is your edge. It's what will give you the conviction to buy when everyone else is selling based on a negative headline. It's what will allow you to identify the key performance indicators that truly matter, while everyone else is distracted by the noise of quarterly earnings beats or misses. This edge, built through the hard work of the Hunter's Toolkit, translates directly into superior executive decision-making and, ultimately, a rate of capital gains that is inaccessible to the speculator. It is the foundation of a truly professional approach to stock picking. We have now reached the final and most crucial pillar of this entire philosophy. You can learn to ignore the media, master the economics of obscurity, develop the mind of a contrarian, and build a powerful analytical toolkit. But without this final element, all of it will be for naught. This fifth pillar is the superpower that amplifies all the others, the force that turns good investment ideas into life-changing wealth. It is the simple, yet impossibly difficult, discipline of patience. In a world that glorifies speed, instant gratification, and constant action, the ability to do nothing, to sit quietly and let a brilliant investment compound for years and decades, is the ultimate competitive advantage. The market is a device for transferring wealth from the active to the patient. To fully grasp the immense power of this idea, we must look at one of Buffett's most famous investments, one that seems to contradict the theme of obscurity, but in fact perfectly illustrates the principle of patient compounding. The investment was in the Coca-Cola Company in 1988. By this time, Coca-Cola was no obscure hidden gem. It was one of the most famous brands on the entire planet. How does this fit with our thesis? The key is not the obscurity of the business, but the context of the time. The market's attention was not favorably focused on Coke. The company was still recovering from the massive reputational blunder of its new Coke launch in 1985, an event that had shaken confidence in its management. More importantly, the entire stock market was still reeling from the crash of October 1987, Black Monday, a day when the Dow Jones Industrial Average fell by over 22% in a single session. In the aftermath of the crash, fear and pessimism were rampant. Investors were terrified of another Great Depression. They were dumping stocks, good and bad, indiscriminately. In this environment of short-term panic and lingering doubt, Buffett saw an opportunity. He looked past the noise of the recent market crash and the new Coke fiasco and analyzed the enduring economics of the business. He saw a company with a simple product that was sold in nearly every country on Earth. He saw a global distribution network that was a virtually insurmountable competitive advantage. He saw a brand that was so powerful it represented a share of mind in billions of consumers, giving it phenomenal pricing power. And because of the market's fear, he could buy this incredible economic machine for about 15 times its earnings, a very reasonable price for a business of its quality and global growth prospects. So, in 1988, Berkshire Hathaway began aggressively buying shares, ultimately investing over $1 billion to acquire a substantial stake in the company. But the most important part of this story is not the purchase, it's what he did next. He did nothing. He held. He didn't sell in 1990 when the economy went into a recession. He didn't sell in 1995 after the stock had already appreciated enormously. He didn't sell during the dot-com bubble of the late 90s, when old economy stocks like Coca-Cola were dismissed as dinosaurs and investors were clamoring for tech stocks. He simply sat and allowed the power of the business to work its magic. Coca-Cola continued to grow its earnings around the world, and it consistently raised its dividend. That initial $1 billion investment has since grown in value by more than 20-fold. But even more astoundingly, the annual dividend that Berkshire now receives from its Coca-Cola shares is more than half of its entire original cost basis. Every 2 years, they get their entire investment back in cash, and they still own the stock. This is the staggering power of patience. Buffett's genius was not just in identifying a great business at a fair price. It was in having the temperament to hold it for decades, through thick and thin, allowing the miracle of compounding to work on an uninterrupted base. The psychological barrier that prevents 99% of people from achieving this kind of result is a powerful cognitive bias known as hyperbolic discounting, or more simply, present bias. As humans, we are wired to value immediate rewards much more highly than future rewards, even if the future rewards are significantly larger. We would rather have 1 marshmallow now than 2 marshmallows in 15 minutes. This instinct was useful on the savannah, where the future was uncertain, but it is devastating in financial markets. The financial industry is masterfully designed to exploit this bias. Everything about the modern market experience, the real-time quotes flashing on your screen, the buy and sell buttons on your trading app, the breaking news alerts, is engineered to trigger your present bias, to encourage you to act now. It creates a sense of urgency, a feeling that you must constantly be doing something to improve your returns. This leads to overtrading, chasing hot trends, and selling great businesses prematurely to lock in a small, immediate profit, thereby forfeiting the massive, long-term gain. Patience is, therefore, the ultimate arbitrage opportunity. In a market full of participants who are psychologically incapable of thinking beyond the next quarter or the next year, the investor with a 5, 10, or 20-year time horizon is playing a completely different game. They are arbitraging the market's inherent short-sightedness. To cultivate this superpower of patience, you must adopt a mental model that fundamentally changes your relationship with your portfolio. This is the 5-year rule and the gardener's mindset. It is a framework for forcing a long-term perspective. Step 1 is the 5-year rule. Before you buy a single share of any stock, you must make a solemn, written commitment to yourself that you will not sell that stock for a minimum of 5 years. The only exceptions are if you discover your original investment thesis was based on a fundamental error, or if the business has been permanently impaired by a disruptive change. This rule acts as a powerful filter at the point of purchase. It forces you to ask, is this a business I would be comfortable owning if the stock market closed for the next 5 years? This question immediately eliminates short-term speculative bets and focuses your mind on the long-term durability and quality of the underlying enterprise. You are no longer renting a stock. You are buying a fractional ownership stake in a business. Step 2 is to adopt the gardener's mindset. Think of your portfolio not as a list of flickering ticker symbols, but as a carefully cultivated garden. Your individual investments are the seeds you have planted in fertile soil, high-quality businesses. Your job is not to frantically dig up the seeds every day to check if they have sprouted. That, of course, would kill them. Your job is to be a patient steward. You water them occasionally, perhaps by reinvesting dividends or adding to your best ideas during market downturns. You pull the rare weed, a business whose fundamentals have truly broken, but for the most part you let the powerful forces of sun and time, business growth and compounding, do the heavy lifting. Step 3 is to institutionalize this patience through a quarterly check-in. Instead of checking your stock prices daily or hourly, which only serves to expose you to meaningless, emotionally jarring volatility, you should limit your portfolio review to once per quarter. When the company releases its quarterly earnings report, that is your time to check in. Read the report. Is the business, the actual garden, still healthy and growing? Is the story on track? This simple, disciplined routine shifts your entire focus from short-term price movements, which are random and unpredictable, to long-term business performance, which is the ultimate driver of your financial freedom. The path of the 99% is a frantic, hyperactive dance of impatience. The modern brokerage ecosystem, with its gamified apps, zero-commission trades, and social media integrations, has transformed investing from a long-term discipline into a high-speed, casino-like video game. The retail investor is conditioned to think in terms of days, hours, or even minutes. They jump from one meme stock to the next, chasing narratives and momentum. They are constantly churning their accounts, selling a stock that's up 15% to lock in a quick gain, only to watch it climb another 500% over the next few years. This constant activity is ruinous for 2 reasons. First, even with zero commissions, there are hidden costs, like the bid-ask spread, that eat away at returns. Second, and far more importantly, this strategy is a tax nightmare. By selling within a year, they are constantly realizing short-term capital gains, which are taxed at the highest ordinary income tax rates. They are voluntarily giving a huge chunk of their profits to the government, year after year. They never, ever give a great business the runway it needs to compound wealth in a tax-deferred way. They are perpetually selling their flowers to water their weeds, a strategy that guarantees their portfolio growth will remain stunted, and their dream of wealth management a frustrating illusion. The direct financial connection of patience is the most powerful force in the universe. the magic of compound interest. Let's make this tangible. Imagine you invest $10,000 and manage to earn a solid 15% annual return. An impatient investor might hold it for 5 years. At the end of that period, their $10,000 will have grown to just over $20,000. They have doubled their money, and they feel pretty good about it, so they sell to lock in the profit. But the patient investor, the one who holds for 30 years, experiences something entirely different. After 10 years, their $10,000 is worth about $40,000. After 20 years, it's worth over $160,000. And after the full 30 years, that initial $10,000 has transformed into over $660,000. Notice the pattern. The returns are not linear, they are exponential. The gains in the last few years are far greater than the gains in the first few decades combined. The impatient investor who sells after 5 years gets a nice profit, but they forfeit the truly life-changing wealth that comes from the long, uninterrupted runway of compounding. Patience is the price of admission for earning these exponential returns. By exercising it, you allow the earnings of your businesses to be retained and reinvested, generating future earnings on an ever larger base of capital. This is the simple, open secret to how all great fortunes are built. It's the ultimate financial advantage, the final piece of the puzzle that transforms this entire contrarian system from a clever strategy into an unstoppable engine of wealth creation. You have just invested something far more valuable than money. You've invested your time and your attention to acquire a powerful new mental framework. You've moved beyond the noise of the headlines and the emotions of the crowd. You now possess the 5 core pillars of a rational, contrarian investment philosophy. You understand the curse of the spotlight, the economics of obscurity, the mind of the contrarian, the hunter's toolkit, and the superpower of patience. This is more than just a stock-picking strategy. It is a complete operating system for making intelligent decisions in a world that is designed to make you act foolishly. You now have the ability to protect your capital from the market's most dangerous narratives and to position it for growth in the quiet, neglected corners where true value resides. But it is crucial to understand that what you have just learned is a single, powerful node in a much larger, interconnected network of mental models. The system that masters like Buffett use to analyze the world is not a linear checklist, but a latticework of overlapping concepts. The ability to find an undervalued company is powerful, but it's exponentially more powerful when combined with the ability to properly assess the quality of its management, or to understand its position within the broader macroeconomic cycle. Each model you master strengthens and informs all the others. You have just forged a critical piece of your mental arsenal, but the map of true financial mastery is vast. The video that is now appearing on your screen is not a random suggestion. It is the next piece of that map. It is the missing link that connects the principles of finding undervalued assets to the next crucial layer of analysis. Think of it as the lens that will bring another part of this complex financial world into sharp focus. The journey to becoming a truly independent financial thinker is a continuous process of building this latticework, of adding new models and connecting them to what you already know. The choice you face now is a simple one. You can stop here with the powerful tool you have just acquired, or you can continue the ascent. The click is not just to watch another video. It is a declaration of your commitment to completing your mental toolkit, to becoming one of the few who can navigate the complexities of the market with clarity, confidence, and a durable, lasting advantage. The next piece of the puzzle awaits. Continue your journey.